Okay. Um, so the camp continues, although although this week was a little bit more agitated than the rest, than the previous weeks. I mean, more agitated depends on how you look at it. It's really Friday that was a little crazy. We can start with this chart this week. So this chart is very straightforward to read. Every bar gives you the amount of realized volatility we've had over a period of 7 days, for instance, 14 days, 21 days, and then 30 days. And then the first one is obviously the last session. And then you have two forecasts, the forecast for the day, so using data from Friday, and then the data from the prediction from the session right before. So that usually helps to get a sense of, are we predicting things to go higher, or are we predicting things to go lower in general? It's pretty hard to get a precise number of where realized volatility will be, but at least you can get a sense of direction. And based on the close on Friday, but overall the session on Friday, that was, quite shaky, right? Opened down quite a bit and then tried to go back up, go down again, like a lot of back and forth. So realized volatility on that day was well above 20, which is what explain the fact that the prediction right now is slightly higher than the prediction we were making on Thursday. That said, it's not like we're starting to predict again some crazy numbers, right? And it's going to be interesting to see what Monday is going to bring, and see if we're getting closer again to a 12 and a half, 13, or if Monday, Tuesday maybe are super agitated, and then yeah, we probably start to converge again where with 13, 14 in line of sight. But we're not there yet, right? Again, those are prediction, and sometimes the best prediction that you can make is what exactly was the number we've seen over the last 30 days, and it's a fairly low number, right on the 10th and a half. So nothing. I mean, again, like nothing. Even though we keep talking about Iran here and there, nothing crazy really happened over the last 4 weeks. And if you put math aside and you look at the different catalysts, especially on the geopolitical front, sure, like something can always happen. We'll be talking about Uzo in a minute. Something can always happen, but eh, the market is now aware of that situation. We're aware that the Hormuz Strait is closed. We're aware that like there's some tractation between the different parties, that at some point, hopefully we will get a deal. Not exactly sure when, but people are aware of that. So to go back to what we had in late February, March, you would need to have a pretty much open conflict, and at least as bad as what it was. And at least for now, again, when you open the FT, the different financial news and stuff, financial outlet, that's not exactly what transpires. So, okay, right, like we're predicting around 12 and 14 realized over the next 30 days. Last 30 days, we did 10. That's a fairly reassuring regime that kind of confirm what, once again, the data shows. It's been pretty calm, pretty quiet for 3 weeks. It's probably going to be calm and quiet over the next 2, 3 weeks or so until again something pops up. Um, I talked a little bit about NVIDIA and the FOMC this week. So this is it's always a tricky one, right? Because we're changing chairman, and it is a possibility that these guys start with fireworks and say something absolutely crazy, and the market will need to adjust with his communication style. The problem is, as we will see in a second, the market doesn't seem to be in a mood where it wants to give a lot of a lot of slack, I would say, to the next chairman, right? The bond prices are already quite high, at least from a rate perspective, so the price is low. So that's going to be an interesting one. But if we just stick to numbers, if we just stick to okay, that's one event in what is likely to happen over the next 3 weeks, it's unlikely that that particular event on the FOMC is going to trigger something, basically a regime change, right? It's possible, right? We don't want to say it's impossible, that's not going to happen or whatever. It's always possible. It's unlikely, and therefore, when Tuesday and even Wednesday and even potentially Thursday, when market digest what Wash will have said on his first conference, it's going to be important to keep, especially if things start moving around quite a bit. It's going to be important to keep that in line of sight. In line of sight, to not necessarily be how can I say that nicely? Impressed, let's say, by markets moving around too much. Obviously, you always want this is the hard and almost the art part of the job, right? As opposition to art and science, where it's always sometimes you have to gauge, okay, is this thing real or is the market overreacting for something? Obviously, we'll know that better as the week moves on. But yeah, I thought I reiterate that because I can see already the circus that's going to be around his first press conference, and potentially the market lose 2%, and then people get crazy again. What was interesting though is that Friday we lost, I think, 1.5%, maybe 2%, something like this. Um, you still have a fairly decent contango in the term structure. So why exactly did we lose 2%? I'm not 100% sure. I think it's fair to attribute that to some of the move in bonds, but it's also very fair to say that vol didn't pick up particularly on the way down in equities. Some people will say it was May expiry, it's not impossible, it's possible. But at the end of the day, all of that to say that um, a move up or down 1% or more in equities market is happen, right? You don't always need to have a super savvy and super smart explanation about it. And in the case of volatility, it didn't particularly react. And really, that's an information in and of itself. So again, I know there is this guy that talks on um, on Wednesday. I know that we never really heard of him before. That apparently has strong views uh, about tightening the Fed's balance sheet, which is quite opposite with what Trump wants. So it's an interesting viewpoint and perspective that he has right now. He definitely has a ton of problem on his hand. Like I definitely don't want this guy's job. With the price of oil rising and Trump as a president. But yeah, we'll obviously listen very carefully to what he has to say. But the market is already listening, right? That's pretty much what I was writing on um, on the newsletter today. You don't go in the bonds. Obviously, you can. We have a few examples here and there, but you you usually have some sort of like catalyst and reason. You don't go from there. You don't add 2 3 points in bond implied volatility for no reason. You can add 2 3 points in stock volatility for, I don't know, like circular stuff or circular spending around AI or whatever new theories that the market is going to get enamored with. But with bonds, it's harder to make the bond market move, right? There's so much money in bond. Bond is the biggest market in the world, much larger than equity. So when you take 2 3 points in implied vol, it's something to pay attention to. In fact, I'm looking much more this than this over the press conference. I hope it was pretty clear from the newsletter. But I thought I would say it explicitly in the call because I'm mostly talking about SPY when I'm on Discord and even in the newsletter. But yeah, this is worth paying attention to, right? And basically, what we want to see at the end of the week is, are we still in that regime where, okay, we classify it as positive VRP and for good reason, right? You have 3 points VRP in bonds. That's a lot. It's not common. So are we staying in a regime where vol in bond is now at like 13, 14, not necessarily climbing more when it was in stress mode throughout the Iranian war? Or yeah, are we climbing again? Like, and if we're climbing again, personally, I don't think we're climbing again. I think we'll slowly be climbing throughout the year as we have more data around inflation, especially if inflation is bad, and as more pressure will be put on the Fed by the market, but also potentially the White House. So I don't necessarily expect that to happen right now over the next week, but over the next few months also, definitely something I'm paying attention to. And here, what I want to see, the answer I want to see from the market is, are we going back to 10 as soon as the guy has spoken? Wash has spoken, we're back to 10. Okay, it was basically the market buying hedges as it done so many times before, and as it will be doing in the future for so many times. And okay, heard what markets participants heard whatever they need to hear, and then they get rid of their insurance. Or yeah, are we saying that now like a price of 12.13 is what we need to get used to. 12.13 is not, it's not absurd as a price in bond, right? You look at 2025, for most of 2025, the second part of the year, that's where we were. So you shouldn't also think that vol at 13 in here is something out of this world. If we roll back to a few years back, um, we'll see that in the grand scheme of things, we're on the lower side. So those are the years post post hike, or yeah, post hike from the Fed, and then with all the questions around, okay, are we going to decrease the rate? Are we not going to decrease the rate? That was the bit of a dance between Powell and the market for a few years. So I mentioned it again in the newsletter today. I talked a few times about this the last few months, but I think it's a fair trade to buy some volatility in bonds for the next few months or so, because again, I think literally 2 weeks ago we talked about this. I don't want to dive too much into macro because that's not what we do here. But you also don't want to ignore. You don't want to be a quant that's just ignoring everything that's happening around it and just be so much focused on the data that you're missing the obvious the obvious situation that's unfolding in front of us, right? Hormuz is closed. Oil is at $100. The gallon of gas in the US start to be a bit expensive. You have energy emergency meeting different countries in the planet. Inflation is starting to go up. The Fed balance sheet is not in great shape. The deficit in the US is not in great shape. Without diving too much more than that in macroeconomic lesson, should implied volatility really be at 13? Okay, I'm not going to be commenting too much, but would I be shocked if it was there? Maybe not, right? Considering everything that's happening. So it's yeah, like you're basically, I'm not saying be long vol in bonds so that you make money out of it. I'm saying be long vol in bonds and potentially in equities, but much more in bonds because I think it's a trade that concerns more the bond market than the equity market at the moment. Uh, but yeah, just be long vol here so that when things go up or keep going up, you have some wings, and it's always the same mechanic, right? Because you can start harvesting very expensive option in the front, potentially very expensive tails, but you can sleep at night because you have those wings. So it's always annoying because yeah, they cost money and data, blah blah blah. Okay, but you replay what we did over the last 3, 4 months, and I know for some of you that it was the first time you really went through a period like this with wings, and it's just a complete different trading experience because those wings bring capital, they bring liquidity in the account when you when you need it the most, right? You're not going to go through margin calls and stuff like this, and you can even trade, right? And sometimes trade the opportunities, the amazing opportunities that are being laid in front of us. And let's be clear, okay, right now we're in fairly calm regime and a little bit of a positive VRP regime. If we compare to a situation like this, yeah, like selling 13 is nice, but if we can sell 15, 16, 17 in bonds, yeah, it's not bad. But you need to be equipped for it. So yeah, that's probably. I know we talked about this 2 weeks ago, but yeah, insist on it. Um, and then maybe at the end of this week, market goes back down from an implied vol perspective in bonds, and then we forget about it for a few months. But the big stuff every year for bond traders and for the Fed is Jackson Hole in August. It's going to be his first Jackson Hole before September, before the midterms. You know, you have enough there to be like, yeah, like maybe this guy make a mistake or say something a bit stupid and the market doesn't react well to it. And and you have a bit of an event. In any case, variable is going up, realized vol is going up, implied vol is going up. Also, um, I mean, I don't want to say do not trade. Obviously, you do want to trade in situation like this, especially if the odds are on your end. But yeah, just be hedged. It's as simple as that. Like it's still cheap to hedge. Hedge it. My market intuition tells me that we'll be talking a lot about bond over the next 6 months, and maybe completely wrong. And in that case, okay, that's fine, fair enough. Um, but yeah, let's see. The other one that's almost funny now because it's in a calm regime again. It's oil after months of spikes and craziness. It seems like it's found some footing with implied being still fairly expensive, right? Implied at 17 oil is not, it's not cheap. VRP wise, it's not, it's the paradox, right? It's not, especially at 30 days. When you have realized at 50s, 55, um, volatility clustering, and we see it really well here right now, that cluster, right? Like implied is clustering around here and realize has gone down, but it hasn't gone down to like 45, right? That's a key, that's another key lesson for people trading volatility. We tend to always say, okay, well, it spikes and then it mid reverse. Sure, but more than mean reverse, I mean, another key feature is that stickiness and that ability to cluster. We're not out of the woods yet, and when you have 11 points of VRP at 30 days, that can be that can come and bite you pretty hard. So for me here, the situation hasn't changed too much in the sense that I still think that the trade is mostly on the call side. Um, and mostly in the shorter expiry. So depending how you trade it, in CL you have daily contracts. Otherwise in Uzo you have somewhat daily contracts. I mean you have some contracts. Um, you have weeklies and a little bit more than weeklies in Uzo in the first few weeks. But you basically come at 2 weeks, 10 days, 1 week, and you keep selling 20 delta calls. You're probably going to be able to get away with it. Um, as usual, I still think that the best way to hedge that is to not go crazy on the sizing, right? I see some of you that are delta hedging it, and it's a good thing, especially because the backwardation is so pronounced. If you do it with CL, the backwardation is so pronounced that the contract tends to. I think now we're in the June contract as a front month. If you buy July, like it tends to drift up because it has to converge towards the spot. So it's not a bad thing to belong, but it's always the same thing. I mean, the key feature when you have realized at 55, it clusters, and at 55, things spikes, right? You can wake up one day. I mean, the likelihood again, it's just basic math and distribution, but the likelihood to see a 10% move when you have realized volatility at 55 is something like, I think it's astronomical. It's something like 5, 6, 7%, something like this. It's not even 0.5% when you have realized at 20. So it's possible tomorrow you have a big news or something like this, and you have a gap down by 10%. We've seen that so many times the last few weeks that and obviously both ways. But it sucks when you delta hedge because you just end up paying gamma because you have that 10% move down, and all of a sudden the delta on your calls was not enough to cover the big move down. So it's not really nice, and it's always a bit of a pain to manage. So personally, my advice is keep it small enough so that you don't need to delta hedge. Um, Stick to anything that's above 20 delta. I don't think it's necessarily the regime right now where you want to do anything fancy with tail swaps or anything like this, right? You want to do that here when market is clearly stressed and people are scrambling for insurance contract or anything like this. But right now, yeah, 20 delta gold, you sell that. And on the short expiries around here, you're probably going to get away with it. Um, but yeah, just be careful. We never know. We never know with oil these days. Vol is quiet again. Um, let's see if that stuff stays like this for a while, or if it converges down. To be honest, I would have expected after, especially after the Chinese and US meeting, I was actually expecting Iran to make some sort of announcement to say that they will reopen the Hormuz trade because China would make some sort of pressure on them. Like they talked before the summit with Trump about it. They made a joint statement with Trump about it, saying that they share the same views. Um, Now, between sharing views and then taking some concrete steps, there's probably a world. So we'll see. But yeah, all of that to say, it's not a stupid position to delta hedge. In fact, it is the right thing to do. Um, Another way is always don't delta hedge, but keep it small enough and react if there is a problem, but you don't want to have to react on the way down. It's always more annoying. I think that's it. What else did I had in mind? Yeah, I mean, this is the same stuff. Uh, it's not too much event risk right now in Uzo, And yeah, I think I posted this. Um, yeah, yeah. Oh, yeah, yeah, yeah. Yeah, I posted this in the newsletter. Yeah, that's a good reminder for I have that question on a very regular basis. Um, because yeah, like you obviously have Ben or Jim Croissant or whoever that says on a I think someone sent me an interview of Jim Croissant, actually a very recent one, where he basically says that implied vol is too low in stocks, it should be much higher, and then there is no VRP, and anyone selling options these days is a complete moron and all that stuff. I mean, I get it, right? Like at the end of the day, you're marketing and we're not playing the same game at all, right? These people manage people money. And again, I wish them well, but you have to be careful with, and I think I don't want to be done dancing on his grave. That's not the goal here, even though it's no I also don't want to be an hypocrite, and I basically didn't really like the guy, and not gonna be too sad about it for him. But you have to be careful. I think it's the responsibility of any retail trader to be very careful about what these guys are saying, and it's not because they have the following. It's not because they have the street cred, literally that they're not immune to saying complete garbage and complete nonsense. They're not playing the same game. They're still marketing something. They're marketing their fund to investors that are trying to get their money managed by savvy people. But as a retail trader, your responsibility is to assess the veracity of what they say. And in that case, I mean, obviously, I'm kind of nitpicking because I could take that chart on a much longer period, but it would pretty much spark a debate, right? But he would pretty much say that, like, yeah, the VRP is not dead. You can't say something like this. And this is one of the cleanest expression, right? Like, if variance risk premium was dead, then selling at the money straddle in stocks right now would at best be flat. Uh, the win rate right now, I'm not even gonna have fun computing it, but the win rate over the last 52 trades is probably 90%. So I think that says it all. If you guys have questions, I'm happy to answer.
Hi, Alex. I do have one question. Maybe it's
Yeah,
something
sure.
a little bit theoretical, so tell me if so. But it's regarding realized volatility. I'm pretty new to this BRP kind of stuff, and I'm reading
Yeah.
Iwan's books and hearing to some interviews. And I'm wondering whether, like, how do you assess whether the realized volatility estimate that you calculate is correctly capturing for the drift? Like markets in the past months have gone up by more than 20%, and we are seeing like a realized vol metric that I don't know if it's capturing this drift.
It's a very good question. So the way we compute realized volatility at Sharp2 is a bit different from what you will see in most of the quant literature for retail traders. In fact, actually, in one of Yuan's book, he talks about this in volatility trading. Actually, he talks about that technique. We compute it with log returns, right? The classic. But instead of doing it day to day, we do it by 5-minute windows. So that has two very neat properties. The first very neat properties is that the drift that you talk about, it can be very apparent when you do it on day by day because the period is much bigger, right? But it's completely nullified if you decrease the sample size, right? When you go from one day to 15 minutes or 5 minutes, it tends to completely decrease. And we do that for all of our tickers. So ultimately, you can remove the drift when you do it that way because it becomes really negligible. If you were using 1 day or 1 week, yeah, you would have to be thinking about problems like this, but we don't. That technique doesn't come, it's not free as everything in finance. You have other problems with it. And in particular, you have the very well-known problem of market microstructure, and in particular, the bid-ask, the impact on the bid-ask, especially for very liquid tickers. But again, most of our tickers, it's SPY, Qs, IWM, so you're not really impacted by this stuff. For some obscure ETF that trades once in a while, eventually, sometimes I'm looking at the readings and I'm like, yeah, maybe there is something there, but it's really for some obscure ETF. For most of the stuff that pops up on the dashboard every single day, you're fine. But yeah, it's basically high frequency realized volatility. In the literature, you will see it under integrated volatility as well if you want to read papers about it. And it has some very neat properties. Using it, if we have to talk a little bit about math, it's basically a big integrals of the 5 minute log returns, and this stuff naturally nullify the drift because the sample is pretty low. So you're good.
Great, Alex. We'll check. Thank you.
No worries.
Alex, I have a question about the US uh, discussion. Uh, so
Sure.
14 DT, but still mostly calls because I was checking, but the skew is not really there as much, right? Or is
Yeah,
it
it's
better to
not
see
there.
this with heads?
Yeah, it's not there as much as what it used to,
Yeah,
right? Like if you compare to a few weeks back,
yeah,
but it's still probably better than trying to go there. Again, this is where you start to play a little bit of poker, right? Like you have a bit of a special situation.
yep,
So let's start here. It's not absurd in my mind to go strangle again, like and be delta neutral. It's not absurd. You can say that right now the state of affair in oil, things can gap up or they can gap down. That said, I have at least until proven otherwise, I have a few. I only sell puts when I start to be annoyed with some of my calls here, and I need to. So you end up still having some. I still have some sort of strongholds, right? It's still fairly delta neutral, but
yeah,
I kind of leg into it. I start with the core side, and then if they become a bit annoying, you start selling a few puts and
yeah,
then you see what's gonna happen. But yeah, I agree. The skew is not as pronounced. I still think
yeah,
the calls are a little bit overpriced here.
yeah. I've been like, if it's MCL, I've been doing just, I begin with calls usually, and then I do end up having to sell some puts as well. And then it overall becomes like slightly delta negative. And same thing for if I'm doing CL, it's usually spreads, but then I start with call spreads, but I do end up having some put spreads. They
Yeah, that
both
makes
sort of,
sense.
yeah,
That totally makes sense. It's the kind of special situation in my mind where you have to you have to adapt, and you're basically playing a little bit of poker. Obviously, you want to be data driven, right? Don't do that on something where you don't have data, but it is justified in my mind to, okay, start with one side and then potentially add the other one if you have to, and then manage the position this way. But the trade is still the same, right? Like you harvest VRP, you start by the options side that is most likely more expensive than the other, and then you manage the position.
okay. And I think, like we discussed before, this is still, I am at least looking at it as a way to buy the TLT ball later in the year.
And yeah, the TLT bond. So we talked a little bit about this. Yeah, so I think that's the best answer I could give you to your DM, right? It's like at 12, it's obviously it's not 10 anymore, and it's going to be interesting. I'm very curious to see what happened after the FOMC, right? If we just drop back to 10. But in the grand scheme of things, 13 is not exactly expensive. We've seen it much higher than that. And it's also important to remember that 1 point in implied vol in TLT it's a lot. It's not. I mean, you compare to equities during Liberation Day, we went to 26. So you don't want to do like for like comparison, obviously, but yeah, 15, 16, 17 start to be expensive. 12 and a half, it's not expensive. It's not cheap anymore. I think below 11 and a half, it's definitely cheap. But 15, it's going to be an interesting price. Yeah, 15, 16. Now, if we go to 15, 16 post FOMC, I'm not going to lie, I'm going to be a bit surprised. Um, and if we go to 15, 16 right after this FOMC, I mean, we're going to have a very funny second part of the year, I think. Because again, you don't move implied vol in bonds that easily. That stuff, there's a lot of money in bonds. You don't move bonds prices like this. So if the
Yeah.
entire marketplace feels like they need to buy options for the second part of the year after what they hear on Wednesday, that's going to be fun. So let's see.
Oh, it's this Wednesday. Okay, I thought it was later.
No, it's this Wednesday, no, unless I'm mistaken. Yeah, I think it's this Wednesday. You had this Wednesday, you basically have Nvidia, and then right after, no, you have Wash first, and then right after that you have Nvidia.
Gonna be
So
a fun
funny
week.
Wednesday. Yeah, funny Wednesday. And then after that it's nothing because isn't it Monday it's closed, I think in the US, isn't it? Next Monday, not this Monday, but next Monday. Which
Yes,
day is
I
it?
think 25th.
It's
I think it should be closed.
It's Kentucky Derby. What's the holiday for Kentucky Derby? I always forgot. On
Memorial Day.
Monday. Memorial Day. Yeah, Memorial Day. Exactly. Exactly. Cool. All right. Any other questions?
Oh, thank you. I'm gonna drop off and go play football. I'll see you later.
Okay. Have fun. All right. Thanks, guys. I see you in the Discord. And
Thanks,
as
Alex.
usual, if you have questions, don't hesitate. See you, Lauren.
Bye.
Alex.